Estate Hustlers podcast. I am your host and founder of Appleman Properties, Josh Appleman. Today we're joined with Lenny Bendo. Lenny is a seasoned executive with a rich history in Fortune 200 companies, now exploring multifamily real estate investing. Beyond work, he contributes to various boards and community programs, exemplifying dynamic leadership and services. Lenny, we are happy to have you here today. If you could let the listeners know a little bit more about yourself.
Thank you for the invite to talk to your listeners. A little bit about myself. Like you said, I started in corporate America. First company was Pillsbury General Mills. Second company was Johnson & Johnson. And then the third company was KraftHeinz. And I really started in sales and marketing. But by the time I got to KraftHeinz, I was asked to do an international business development assignment in India. And then that developed into managing or improving the business development in the emerging markets, which was Asia Pacific, Middle East, Africa, Eastern Europe, and Latin America.
Wow.
Systems implementation, which is an IT thing, and I don't have the IT background. And then finally, I was asked to move into the C-suite with as Global Chief Diversity and Inclusion Officer. And so that's an HR role. A lot of these aren't necessarily my expertise. And I think what was great, and I was fortunate, is that I was able to pivot or adapt and move into different areas that aren't necessarily my expertise, at least initially. And I think that's a good pivot into getting into real estate. Don't have any real estate background, really don't have any property management, any insurance or that finance background. And I think my ability to adapt has really helped get me off to a great start in real estate, particularly multifamily. And as a side, other thing that I do is I give back to my community. That's really important. It's part of the reason why I'm doing multifamily real estate. I serve on the board of directors for my international fraternity, Lambda Chi Alpha, and I also serve on the board of directors for the History Center here in Orlando, which is where I'm based. So
Nice.
Great to be here. I feel really honored. This is my first podcast, which I told Josh before he started.
Yeah, we're happy to have you here. Got to start somewhere, right? There's a first for everything.
Absolutely.
So you've got a great background, and you've seen a lot of companies how they operate at a very, very high level. Few people get to see what's behind closed doors at some of these very large corporations, and you've done just that. So it's an incredible experience. How would you relate big corporate with multifamily investing? Is there any correlation at all?
I think the biggest thing is that entrepreneurial sense, being able to read people and work with people that you might not necessarily either know, like, or want to work with. And so you have to kind of overcome those obstacles at every point. I'm like, you always have to evaluate the situation and evaluate the people and decide what you need to do. Sometimes you can carry it forward. Sometimes you need to step back. Sometimes you need to push or really just get down to what the challenges are and tackle those. And I think that's universal across any entrepreneurship, any business, any corporation.
Absolutely, for sure. Yeah, that's spot on. So what are the three questions that you would ask people if they wanted to invest in you? What would the three questions be?
I think in the conversations that I'm having with regard to investing with my company and with our deals is the first one has to be, why real estate, right? Because there are folks that are really entrenched in, I love my 401k, or it's a lot safer for me, or I prefer to play the stocks, I prefer crypto, etc. So that's the first hurdle or question that you might want to ask somebody that you're talking to about investing with you. And then the second question that I typically have to ask is, why multifamily? or apartment complexes versus single family. Because a lot of them understand the single family market because, X percentage of the country has bought or sold a home, right? And so they're familiar with that. They're in terms of the comps and how the market appreciates and how your property is valued is a lot different from what I've learned to multifamily. Multifamily isn't as based on the comps within the market. It is a little bit, but it is definitely more dependent on what the cash flow is for your particular property that you're either working on or considering to buy. And so if it has full occupancy or at least 92% occupancy, that's going to give you a lot more cash flow. If it's at market rent level, you're going to get the max amount of cash flow that you can from that property. So some apartment complex can sell down the road for a fire sale, like you would see in a single family. If a single family, your next door neighbor decides to sell it for half its worth because they just want to be rid of it, right? So if kids inherit it or they're having a divorce, they can fire sell that home, and that brings the value of your home down. And that's not the case in multifamily. And I think that's a big factor that you have to help them understand.
Yeah, 100%. So you're assisting people finding great deals to put their money into deals, and then you're essentially matching the money up with a great deal. But plus, you've got an operator behind the scenes, and that operator is responsible for the performance of the property, the asset management, pushing the rents to market rate, pushing the renovations, making sure that the expenses are crushed or eliminated. How do you identify the operators that you want to place trusted capital in with, and what kind of tactics do you take to make sure that they're who you want to work with moving forward?
Are you talking about the key principals or key partners and general partners?
And you've always got the main operator, the guy who's actually running the entire business plan, executing the business plan, applying pressure onto the property management if there is one. What do you like to see there?
All right, so there's a couple key folks that you want to make sure that you have on your team. The first is a sponsor for sure that you can work with. You most likely want to have that person have similar values to you. You should have actually a couple sponsors at your disposal because not every sponsor is going to be liquid and able to sponsor your property when you want to. And so that person, you have to have some confidence that you're going to want to work with that person, whether it's for 3 to 7 years or if it's on a hold 6 to 10. It's not a good sign if you can't get along with that person, or that person has different values than you, or you find that you're going to you're going to have issues dealing with personalities. And so that person is key. The second, and I'll talk about my partner in this business within Great Dane Capital, his name's Chad Brinkerhoff, and we've known each other for a long time, and he's our asset manager. He has a huge experience. His degree is in horticulture, so he knows everything on the outside to in terms of plant materials, how to improve the curb appeal, etc. He has a huge background in property management or dealing with property management. He was president of the HOA of our home here in Orlando, and he's revived 3 businesses, saving him from bankruptcy. So you want somebody like that as your asset manager, because that person has to execute your plan as keenly as possible. So if you're underwriting or you're planning for a certain capped X budget, you want somebody that's able to execute against that plan without having to go back or back into the investors, because that is a painful conversation. Hey, we ran out of money and we're going to need to raise more for this particular property. And then third person that you should probably have as somebody that you can trust is your underwriter. That person's evaluation of all your deals has to have a really great attention to detail, have a bunch of scenarios underneath all of his options that he's presenting, and really somebody that can plan conservatively. Because, with the market the way it is, there's a lot of stuff that is unanticipated over the last year or two post-COVID. That's been a challenge. Supplies chain for any of the materials or parts, the scarcity of contractors, general contractors that you're going to need to work on your apartment. So that's a lot of number crunching that I'm pretty good at numbers, but it's not something I want to do every day. So you got to be able to have an underwriter that's able to, one, give you the right numbers and actually be able to share that with some of your investors if they really want to dig deep.
Oh, absolutely. Well, and you've got the pillars of what makes up great placement of capital. You've got your man who knows what asset management is, knows how to turn around great. And really, we're in value add. So turning around a complex to increase value is exactly that. It's turning around businesses. And then your underwriting. Your underwriting is key, fundamental to even sending out the LOI and getting under contract, because you know that by the numbers, it's going to be successful. We don't see those deals come around more often than we'd like, but that's the part of it. You underwrite 100 to get hopefully one or two that can pencil out, hopefully, if everything gets through. But that's great. So the pillars are in place. How many deals do you all underwrite typically to find that one, or have you seen?
Okay, so I'll be full disclosure here. I'll be completely honest for you and your listeners. So we were underwriting at least, 30 or 40 deals a week in the beginning when we first started. And we found out, even though we're both pretty good at numbers, we found out I don't think that's what we want to do full time. And so when we finally got on a deal on this 327 unit in San Antonio, it was actually announced at a conference because we got an award at Peak Partnership, which is the big conference for the multifamily mindset, which is Tyler Devereaux and Ryan Woolley's organization. And once he announced that we had this 327 unit property, people started bringing us deals, which has been nice because now we're evaluating deals that have gone under some scrutiny. They've already gotten, the litmus test is like, hey, I don't have to go through deals that suck, right? They've already kind of filtered those out. They're bringing us pretty good deals that were like, hey, can you help us out with this? We're not sure if we are going to be able to raise the capital on this, or we don't have a sponsor. The great thing for Chad and I is we're pretty well networked within multifamily real estate for newbies. And so we probably have almost 24 sponsors that we could go to. And so if they're bringing us a deal, we can okay, this fits so-and-so, so-and-so, and so-and-so's buy box. So we can go to those folks and kind of interview them to see who's the best fit and who wants to sponsor this particular deal. And sometimes it's like a go-to, we definitely want to work with so-and-so on this particular deal. Let's go to them first, find out whether or not they're liquid, if they're still in the market for that particular property. Because some are very particular. I know of one sponsor, he could sponsor up to 100 million, but he only wants Eastern Standard Time Zone. He didn't want anything in Central. And I'm like, okay, we'll work with that.
Make a concession for that guy.
yeah. I mean, we know which ones we need to bring to that guy. I have a 1973 portfolio that we're working on in Orlando that's not going to work yet unless we get it rezoned as opportunity. So I have to talk to the mayor of both Orange County and the mayor of Orlando. It's like, hey, you did this with Paramore. I'd be curious to see if you're interested in doing this again. So it's not even something that's way out of their wheelhouse. This is something that they've done within the Orlando area. It made sense. It's
interesting.
Really,
so it's really. You're engineering the deal, and That's the first I've heard of engineering a deal to a opportunity zone, because you have to hold on to it for at least 10 years to get the tax exemption. But just a tax exemption play. That's all it is, and
Yeah, it's totally.
it doesn't necessarily even pencil out, but that one play can make it work. Is that correct?
Yeah, it's definitely a longer term. We would be seeking investors that are looking to do an opportunity zone, because not everybody wants to do that. They're more focused on the returns. But what we found is some of the investors actually want to give back to the community and find those communities and improve the communities that are C minus, D plus, and really bring them up to level. I mean, the great thing about the properties portfolio that we're talking about is it's adjacent to an A property. And so I'm going to have a conversation. We're having conversations with the owner of the land of the A property, because he definitely would want to invest in that because it'll increase the value of his property and really get rid of some of the security issues or the challenges that he's having of being next to a worrisome area. So that, wow. It's really thinking outside the box.
Yeah.
For this particular portfolio. It's not something we're rushing into. There's definitely bigger conversations we're going to have. And for something that's 1973, three apartment complex portfolio, that's a big deal. I don't want to run into the challenge of the guy in Houston whose property portfolios got taken back by the bank. That's definitely not where I want to be, and that's definitely not the legacy that Chad and I want to leave.
That's funny you brought that up, because I've just was sent the article, the Wall Street Journal's article, twice this week by two different people, and there is a backstory to that whole mess as well. It's not it's one of the hottest markets in the U.S. He lost it totally because of negligence, and it's just. It puts a bad mark out there, because it's like making all these headlines and like multifamily this and that, and it's not the case at all. Multifamily is extremely resilient, but the jockey on the horse who's pushing the deal along and making sure things are going, that's the key element to the deal. And you've got someone who's totally negligent out there that's giving bad press, but. No, and you don't want that. Nobody wants that on their mark, because that's reputation, and you only have one reputation that you leave with every morning, and you got to protect it.
Like I was on several network calls the day after, and that everybody was talking about it. And I just actually, what was interesting is I needed to verify that person wasn't the same person that owned the ones in Orlando, because he sounded very similar in terms of his makeup, because I didn't know exactly the name of the person of the owner or the seller for the one in Orlando, and I'm just like, oh God, I hope that's not the same one.
Yeah, it's and bad thing is I think it's Apple something, and my last name's Appleman. It's like, oh my God,
yeah,
that's not but totally different. I don't even know the guy. I don't know the guy personally. Just reading up on the on them as an operating company, and they even did a capital call with their investors. It's just they created a mess upon a mess for them to.
It's too bad. I mean, because it makes some investors pretty leery about, like, oh God, I don't know if I want to do another big property, because anything can happen, and they're kind of out of luck at that point. And I'm guessing that the raise for the Orlando portfolio is going to be in the 50 to 75 million, depending on where we land in the underwriting. So
that's a nice size deal. That's got to be exciting. If that all comes about and you all get it zoned into an opportunity zone, that would be incredible. You've engineered a deal that would never have worked out and made it into something very favorable. That's huge.
Right.
What is your all's buy box? Because I know we brought up buy box earlier, but what are you all looking for exactly?
So we've kind of pivoted. In the beginning, we were like, we'll do anything over 20 units, and we were frankly targeting all of the Florida markets. So 11 of the top 25 markets back in 2021 were, all here and within 2.5 hours driving distance from Orlando. And, as soon as the issue of insurance hit after Ian, essentially, the numbers aren't working here. So that changed the markets that we were considering. In terms of size, in general, we're looking for something from 200 to 400. We found that the bigger ones are going to have a tougher exit strategy because who you're going to sell to after that, the niche of buyers shrinks significantly as soon as you're over 400 units. The reason why we say 200 is we've learned, or we've at least been mentored, that at 200 you can have an on-property manager, but we are considering anything 100 and above. So we're not in the market the way it is right now. We're not as siloed and focused on a narrow buy box like we used to, or that like some people are. We really, it's like, hey, we're taking on a deal by deal basis. And often, if we have friends within the business or colleagues that we really like that need some assistance, like closing their deal with some capital and investors, we're there to, we know it'll come back. This business is huge. It's all about relationships and reputation. And, if you help them on a property that really doesn't necessarily fit your buyback box, but, they're in a bind and they just needed, 75 million or 350 just to close the deal in time without going through an extension, that's going to come back to us. I mean, everything that we've done in the mindset that it's going to pay back tenfold. Every time we've given to somebody, every time we've helped a colleague or helped somebody that's new, or kind of just advise them, it has come back to us tenfold. It really has. And that's what this is all about.
It is too. I'm glad you brought up you essentially brought up exactly a conversation I had earlier this morning with the broker. You brought up the end in mind first, and I work backwards on everything. The end in mind is how I get to my entry point, and it's a 98 unit, 16 million. And my question to the brokers, when I give this back to you 3 to 5 years later, how much can you sell it for? Because that's the biggest piece, because you've got money that you have to invest for the renovations, for the everything to get to it where it's performing. And if there's not a big enough delta there to where the risk isn't worth the reward, then you got to move on, because when you get to 98 units, your buying pool becomes even smaller. Now institutional players will not touch anything under X units, and then when you're under 100, it's even. So it's like, how does this start to make sense or not make sense? It doesn't matter how much the thing is producing. It's just economies of scale goes away after a certain period. So it's but that's with the end in mind and working backwards. And it sounds like it's exactly what you all do as well. Who's going to be the end buyer when we get done? Very cool.
Yeah.
So you came from corporate, and corporate got you into multifamily, and you love multifamily, you love real estate. What kind of experiences have you seen from your investors as far as the journey along the way?
So we are in terms of their journey so far. I mean, the investors for the most part have enjoyed a really big boom in 2019 and 2020. And so what's happening more recently is like, man, I don't know if I want to do this, or it's a little bit tougher, or they're being a little bit more cautious about, where they're investing. And so we have not gone full cycle through like selling a property yet. And so things have been okay so far. The 327 unit that we're looking at, it kept going. It's dragging along a lot longer than we expected. So it was supposed to originally close March 15th, And because of HUD, it got pushed to end of April. And then our main partner, which is JP Morgan, had to pull out a couple of weeks ago because we're buying First Republic. And so that pushed us out further till July. And so we just have to be full disclosure, transparent with all of our investors. And in the meantime, since it's been a couple of months since most of them have wired, you got to figure out, okay, how we're going to get them any type of return versus the zero that we've had so far. Or it's just going to be a while until they see that cash flow. And so I find being full disclosure, as soon as you share that information with them, they appreciate that. I know that they'll appreciate it in the future. If you try and hide stuff from them, or you're really slow at getting that information to them, or they find out through the grapevine from somebody else that about the challenges, they're less likely to trust you, or you've really damaged your credibility in the future. And that's you definitely don't want to do that, because once you lose the trust of your investors or the confidence of your investors, I don't know if you'll get it back.
Yeah,
I mean, I just assume you're not going to get it back.
Yeah, good, bad, or indifferent. You've got communication's everything. It's not always going to be. We shield so much from the general just by taking care of issues as they come along. If it's a non-issue, it's a non-issue. But you've got to communicate and say, here's what happened this week, this month, but we're hitting our targets. And ultimately, you're in a capital raise for a large property. The people that have already wired have already invested. Mentally, that money has left. And it's ultimately going into bricks, which that's safe. That's money that's out of the bank into bricks. It's safe money. And eventually that money will make babies and come back home. That's the idea down the road, whether it's 5 years, 10 years, whenever it's mentally there. And it's a sense of security that it's very well vested. And that's what multifamily gives anyone who's wanting to take that leap into multifamily investing or real estate investing. It's a sense of where your money's at. It's not tied up in the stock market where you've got these erratic shifts up and down, up and down. It's in bricks, and it's in a building where people need to live and stay and raise their family in a lot of cases. But Lenny, we truly appreciate you coming on the show today. If people want to reach out to you to learn more about Great Dane Capital, how can they get a hold of you?
Easiest way, and it's easy to remember, it's Lenny at greatdanecapital.com.
That's perfect. And then we're recording this, so we'll send it back out so everyone's got your contact information in the post. And we'll definitely talk soon. I like what you guys are doing. Very tight outfit, and definitely appreciate your time.
Yeah, appreciate you having me. And, just anybody reach out if you want to touch base.
Awesome. Thanks, Lenny. You take it easy.